Joining us now, former National Economic Council Director and IBM Vice Chair Gary Cohn, to break this all apart and then try and put it back together again. We just got this breaking news. J.P. Morgan has just lowered its prime lending rate to 7.25%. That's usually what happens when there is a Fed rate cut. But rates are coming down. That's what President Trump has wanted. Well,
the front end of the curve is coming down. You just pointed out that the Fed funds rate is the overnight rate for banks. And in fact, unfortunately, it affects consumers in the wrong way. So if you have money left at the bank and you're earning overnight deposit rates, you end up getting less interest on your money. Right. If you're borrowing money from the bank, those rates did not come down today. So if you're borrowing money for your car, you're borrowing money on your credit cards, you're borrowing money to buy a house, those rates have not come down yet. They have been drifting a little bit lower, but remember, Fed funds is the front end, and what you showed is the curve is actually steepening, meaning long-dated rates are going up today. They're not coming down. So this was a small sort of maybe introductory or maybe the only move that the Fed's going to make here.
Well, that leads to the question of what jumps out at you most regarding what we finally saw from the so-called dot plot, which basically maps what each and every member of the Fed, all 19 members, think the Fed funds rate is going to be at the end of this year.
Look, I think this is the fascinating part of today. So you had one governor say they didn't want today's rate cut, even though they voted for it. You have 6 that say they want no more cuts this year. You have 9 that say 2 more cuts this year. And you have 1 that wants 5 more cuts this year. In 2 meetings, that's a lot of cuts.
And we think that is who?
Well, we can all speculate who we think it is. And maybe the newest member of the board.
The new kid on the block.
The new kid on the board definitely established himself. So if you take where we are today, Fed funds at 4.8%, 4.08%. We're showing a year-end Fed funds at about 3.6%, which is the 2 rate cuts. This is not a seismic shift in monetary policy or Fed policy. This is a gradual changing of policy. And I think the chairman tried to walk us through that. You know, he's in a dilemma. I mean, he tried to describe his dilemma to us today. He says, look, I've got a dual mandate. I've got stable prices, which is 2% inflation, and I've got full employment. Those 2 things are at odds with each other right now. I've got inflation that's over 2%, which is my threshold level where I'm trying to shoot at, but I have employment that's not at a level I want. And I see the employment market deteriorating. So the numbers today haven't really shown up in the unemployment numbers because the denominator is changing. But when he looks at the monthly jobs coming into the system, he sees what we all see. We've gone from 150,000 new jobs a month to 25 or 30,000 jobs a month. So the chairman's trying to say, look, I see that the job creations aren't there. So I'm now weighing, do I fight inflation? Do I fight unemployment? If I fight one, I might be stimulating the other. And he's now into the point where he said, okay, he said, I'll take a risk management interest rate cut here to try and stimulate some more employment growth.
And he had telegraphed that a month ago at Jackson Hole at the big hoo-ha that they had with the central bankers. So when you look at what would happen when it comes to the markets, we are at or near record highs. By the way, the S&P has turned positive here, up 2 points. The NASDAQ is trying to get there. I think at the moment we got the NASDAQ. Let me just quickly check. But as we continue to watch this, the NASDAQ is now down just about 26 points. Dow still up about 245 points. I mean, what is the case, Gary, for another rate cut or 2?
So look, today's move was not negative to risk assets. So they should not affect the way people are thinking of owning the U.S. markets, owning assets here in the United States.
Then why do you think the Bitcoin is down more than $1,170? Risk asset.
I don't know. Look, gold's down, Bitcoin's down. These flight to quality assets, these flight to safety assets are definitely down. People are happy to buy risk assets. We didn't end up with a Fed that was in disarray today. I think that's another message that came out of here. You know, the chairman literally had almost uniform consensus for the vote today. He had 1 dissent. Going in, I think many of us thought there could have been dissents at both ends. There could have been dissent for someone that didn't want to raise rates, and there could have been 3 or 4 dissents for people that wanted to go higher than 25 basis points. When you look at what happened here, they had quite an orderly meeting. The Fed seems like it's in control. The chair is in control. And if you were buying these risk assets in as an insurance policy, the gold or Bitcoin or things like that, you walk away from today going, the Fed seems to be working pretty orderly right now.
Well, let's put it this way. The last time around, around, there were 2 dissenters, Chris Waller and Michelle Bowman.
Yep.
This time around, just 1. And it was neither those 2. It was Stephen Myron, the new kid on the block. And Jay Powell was asked about that in sort of a couched way. And here's what he said about Stephen Myron.
No one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then
I got to tell you, he's probably walking out of there like the cat that ate the canary, meaning Jay Powell. He got most of the team cohesive and together on this.
Yeah, that's a news flash out of here. 1 dissent. And as you point out, 2 dissents last time. Bowman and Waller went for the 25 basis points. You had pretty unanimous group in there today. I think that's a really good moment for the chair, as you say.
Is this going to enrage President Trump, or what do you think he's thinking at this moment?
Well, look, we all know the president wants interest rates lower, and we know that he's looking at certain parts of the economic data. He's looking at the job creation side. Look, if you're looking at the job creation side only, and you're seeing 25, 30, 40,000 job creations in a month, you would want interest rates lower. If you're looking at the inflation side only, you would have a different opinion. The chair's trying to tell you, I've got a dual mandate. I'm trying to balance this. He really has 2 goals that are in opposition to each other, and that's where he is right now.
Well, yeah, exactly. If we can put up some of the markets, particularly the S&P, it is now down 1 point. So, again, the market is trying to feel and field exactly what this all means. We've got some winners: Workday, Hologic, Fox Corporation, the parent of this company, PayPal. There's the S&P at the moment. Just let's call it flat, but slightly lower, which indicates, on these kind of days, we usually see a big jump or a big fall. At the moment, it's sort of like, oh, where are we going here? So best advice to investors, Gary?
Look, I think the Fed told you everything they've been telling you in the past, but it's more important. They're news dependent right now. They're not 100% sure which way the job market's going. The chair talked about he thinks the job market will be improving. So he's telling you that he believes the economic data going forward will be better for the job market. He also said, on his other side of the mandate, he thinks inflation is continuing to come down and they've got inflation under control. So if the job market improves and inflation comes down, the investors should understand that. That means that the Fed does not have to do a lot, even though the chairman admitted they've been in a highly restrictive policy. They'll probably work their way more back towards neutral. But remember, it was a very close call among the members, whether it was 2 cuts or 1 cut for the rest of the year. I don't think it's baked in, it's 2. It could be 1. And I think the markets have to understand that the Fed is just as news dependent as every investor is today.
I think you're right. It's not a sure thing that we will see 2 rate cuts. Gary, great to have you. Thank you very much. This meeting actually takes on added drama because the Fed just revealed the latest dot plot. That dot plot comes out once every quarter and anonymously charts each Fed member's year-end interest rate forecast. No one is better at connecting the dots of the dot plot than Diane Swonk. The Fed regularly turns to the KPMG economic advisor and chief economist for insights and briefings. Okay, make it really understandable. Gary just said, pretty fascinating that we only had 1 dissent and that, we put all of these numbers into the cauldron and out comes the dot plot. You say what about it?
What really is interesting is that we saw basically Chairman Powell corralled the cats. And I think the stronger than expected retail sales numbers actually moved the needle on no dissents from Governors Bowman or Governor Waller. So that only 1 dissent by Steve Moran, looking for more of a 0.5% cut. But this really is no sure thing on another 2 cuts. And the uncertainty, he really underscored that several times. The forecast still has a mild bout of stagflation in it. And that is what the Fed is trying to manage. He talked a lot about the labor market, but he also talked about how unusual this situation in the labor market is, where the break-evens on how many payrolls we need each month have really fallen down to levels that are within the margin of error of zero. That is a very different kind of labor market than we had in the past. That doesn't mean there isn't weakness. I have a lot of sympathy and empathy for how much underlying weakness there is in the labor market. Those who have a job are frozen in place. Those who want a job are frozen out. That is not a healthy labor market. A healthy labor market has a lot more churn. The problem is we just don't know how familiar we've gotten with inflation, and the embers of the pandemic inflation were still smoldering, and the way in which tariffs are coming out, they're coming out in phases. That means you'll have waves of increases in prices or more margin compression, and that uncertainty could unmoor inflation expectations. And that's economist speak, but it really means there's a self-fulfilling prophecy risk out there that the inflation, by expecting inflation by both consumers and firms, it could become a self-fulfilling prophecy, and you cannot get full employment sustained if inflation stays out there, especially given the inequality that we're dealing with right now. That said, if you think inflation is going to go to a little above 3% because of tariffs and then come off, why would you risk a recession for 3%? We're not talking about the 9% blistering inflation that we saw during the height of the pandemic.
Well, look, we should cycle through some of the important points that Jay Powell made when you talk about everything from inflation and the tariffs, which, I think he was trying to thread a needle here, wasn't he, about the tariffs, where he said it's pretty obvious that we have not actually seen the tariff costs that importers are paying here in the United States spill over to the consumer, but that they actually could. That said, I like your comment about how you believe that Chair Powell was able to corral the cats, so to speak, meaning show more unity. Here's what he said about the Fed making this decision together today. Listen.
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change.
President Trump wants to reshape the Fed. I think it's pretty clear, correct? And therefore, with Stephen Miron aboard, Stephen Miron, the Council of Economic Advisors chair, who has taken a leave of absence while he replaces Adriana Kugler on the Fed, he was the one dissent. And it wasn't that he didn't want a 25 basis point cut or no cut at all. He wants 50 basis points. Do we need to see a 50 basis point cut right now?
I think that would be premature, just given, even though I'm very worried about the labor market, we just don't know. And we had the mother of all frontline running in terms of anticipation of tariffs. We have a lot of stuff that's on store shelves that was actually bought before tariffs went into effect. That helped to blunt the blow of tariffs. He also went out of his way to point out where tariffs were showing up in goods prices. Something else the Fed is struggling with is, because of this inequality out there where the bottom 80% of Americans have basically stagnated, lost almost everything they've gained in wages, and spent not anything above inflation because of that, where the top 20% are carrying the economy. That's not a great place to be, but it also is creating this underlying floor under service sector inflation that we've seen emerge out there. In the month, the retail sales numbers were stronger, and he talked about that, yet it had a decline after adjusting for inflation in grocery spending and an increase in restaurant spending. That really gets into the inequality and the role that affluent consumers are playing in holding up service sector inflation that's come up a bit after it had cooled. And that's something that is also worrisome, because that's something the Fed had basically assumed would be a major offset to any of the bump due to tariffs. He did stick to his quote that, the base case is that this will be not all at once, but a one-time kind of increase in price levels that's spaced out a bit because of the uneven rollout, and then it will taper off. That's what the Fed has forecast. And I think this is a very hard, he said, it's challenging when their dual mandate are going in two different directions.
Diane, thank you very much for kind of putting it all together for us as we continue to watch the markets. We appreciate you coming on here.